Assalamualaikum, my name is Muhammad LUQMAN NAIM. My ID number is SIB241101116. And now I will be talking about background history of Mr. DIY and 99 Speedmart and also their recent development. Now, for Mr. DIY, Mr. DIY was found in 2005 in Malaysia. Mr. DIY is one of the largest home improvement retailers in Malaysia. The company sells affordable household, hardware, and lifestyle products through many stores across Malaysia and other countries. Mr. DIY is popular because it offers many types of products at low price in convenience stores. In recent years, Mr. DIY has continued to grow strongly. The company increased its profit, expand more stores, and improve its operation. This development helped Mr. DIY maintain its strong position in the retail industry. Next is 99 Speedmart. 99 Speedmart was founded in 1987 in Klang, Selangor. It started as a small sundry shop and later became one of the largest mini-market chains in Malaysia. That company focused on selling affordable daily necessities in convenient locations near residential areas. Recently, 99 Speedmart shows strong financial growth and opened many new stores across Malaysia. In 2024, the company was also listed on Bursa Malaysia, which became an important achievement for the business. Besides that, the company has started exploring opportunities to expand into international market in the future.
Assalamualaikum, my name is NURHAZIQAH and my ID number is SIB241101149. Today I will explain about the historical ratio analysis of Mr. DIY Group. So from the graph, we can see the current ratio of Mr. DIY Group increased from 2.23 times in 2023 to 2.38 times in 2024. It shows an improvement in the company liquidity. It means the company are able to meet the short-term obligation. Next is the quick ratio of Mr. DIY Group is increases from 0.37 times in 2023 to 0.5 times in 2034. It shows an improvement in the company's short-term liquidity. However, both ratio is less than 1, which means the company may not fully cover its current liabilities without relying on inventory. Next, for the inventory turnover of Mr. DIY Group increases from 2.2 times in 2023 to 2.33 times in 2034. It showed that the company managed the inventory well. It's a positive sign because it shows a better efficiency in managing inventory and help reduce storage costs. Next, the average collection period of Mr. DIY Group increased from 8.8 days in 2023 to 11.5 days in 2024. It showed that the company is taking a longer time to collect payment from customers. It may affect the cash flow and need to check the credit policy. Lastly, the total asset turnover of Mr. DIY Group decreased from 1.23 times in 2023 to 1.22 times in 2034. It showed a very small drop in how efficiently the company used its asset to generate sales.
Now we move to historical analysis of Mr. DIY. In debt management, for 2023, the debt ratio of Mr. DIY is 51%, and for the year of 2024, the debt ratio of Mr. DIY is 49%. Debt ratio of Mr. DIY decreased slightly, indicating that Mr. DIY is relying marginally less on debt financing and showing a small improvement in its financial stability. Now we move to time interest earned. At the 2023, the time interest earned is 11.64, and for the year 2024 is 10.61. It's suggesting that although the company is still comfortably covered in its interest expenses, its ability to do so has likely weakened. In profitability ratio, The net profit margin for 2023 is 13% and the 2024 is 12%. It's suggesting that even though the sales are high, the cost of business has risen slightly. Now we move to return on asset. The return on asset for the year 2023 is 60% and the year for 2024 is 15%. It's showing that the company is generating slightly lower profit from its asset base compared to the previous year. The return in equity for year 2023 is 32% and for the year 2024 is 29%. It's reflecting a reduction in the return earned on shareholder investment, though it remained relatively strong.
Next, for 99 Speedmart's historical ratio analysis, their current ratio in 2024 is 1.74 times, which is a good improvement compared to 1 time in 2023. This means that 99 Speedmart is able to meet their short-term obligation better than before. Next, for their quick ratio, it shows a great improvement since their ratio increased from 0.13 to 0.59. This shows that 99 Speedmart has a better asset liquidity in 2024 compared to 2023. And then for their inventory turnover, there is a slight decline from 6.97 times to 6.63 times. This could mean that they are experiencing inefficiency in inventory management. Next, their average collection period showed that they take less time to turn their receivables into cash in 2024 from 1.64 to 0.55 days, which is a huge improvement. And then for their total asset turnover, there is a decline in 2024 from 3.46 to 2.80 times compared to 2023. This means that they are generating sales a little slower from their total assets compared to before.
Assalamualaikum. My name is NURHAZIQAH and I will present about the debt management ratio. In 2023, 99 Speedmart had a debt ratio of 80%, but in 2034, it went down to 56%. This shows that the 99 Speedmart is relying less on debt, which is a good sign for the financial management. For the term interest earned, it increased from 30.22 in 2023 to 15.62 in 2034. This means the company is earning more compared to what it needs to pay in interest. So it is a stronger position to handle its debt. Now, let's move on to the profitability ratio, which tells us how well 99 Speedmart is performing in terms of generating profits. First, let's look at the net profit margin. In 2023, it was 4.3% and in 2034, it increased to 5%. This improvement means that for every ringgit of sales, the company is keeping more as profit. It shows better control over costs and stronger efficiency in operation. Even though the increase looks small, in retail business like 99 Speedmart, even a slight rise in profit margin can make a big difference because of the large sales volume. Next, the return on asset. In 2023, return on asset was 15%, but in 2024, it dropped slightly to 14%. This ratio tells us how effectively the company is using its asset to generate profit. Finally, the return on equity. This is where we see a bigger change. In 2023, it was very high at 74%, but in 2024, it fell sharply to 31%. It measures how much profit shareholders are earning from their investment in the company. A drop this large could mean that the company has changed its financing structure, perhaps relying less on debt and more on equity. While lower debt reduces risk, it also lowers the return on equity. So shareholders are not getting the same level of return as before. To sum up, profitability improved in terms of net profit margin, but efficiency in using assets declined slightly, and returns to shareholders dropped quite a lot. This shows that 99 Speedmart is becoming more stable financially. but it needs to balance stability with maintaining attractive returns for investors.
Moving on to evaluation of the company's performance, I will be evaluating the company performance based on their cash flow capability, asset management efficiency, debt management, and profitability trends over the 2 consecutive years. For the first one, which is cash flow capability, Mr. DIY Group demonstrates a strengthened liquidity position in 2024 with the rising of its current ratio from 2.23 to 2.38 times. This shows their robust ability to cover the company's short-term obligations, while the company's quick ratio also improved from 0.37 to 0.5 times. Although the figure still remains under 1, which suggests that Mr. DIY Group still relies heavily on its inventory to fulfill their short-term obligations. Likewise, 99 Speedmart saw a significant rise in its current ratio from 1 to 1.74 times, showing a substantial improvement for the company's liquidity to meet short-term needs. The company's quick ratio also rose from 0.13 to 0.59, which is somewhat a good improvement for 99 Speedmart asset liquidity, even if it still remains under 1. However, it is quite common for a quick ratio to fall under 1 for a retail company like Mr. DIY and 99 Speedmart, and it does not significantly indicate a weak cash flow capability. This is most likely due to their inventory-heavy nature of retail industry. Secondly, for their asset management capability, Mr. DIY Group shows a positive momentum as its inventory turnover increased from 2.20 to 2.33 times, which helps to minimize storage costs. However, the company's average collection period slowed down from 8.81 days to 11.50 days. This suggests that they might need to review whether their collection policy is too loose in order to prevent liquidity strain. While looking at their total asset turnover, the rates stay almost the same, moving from 1.23 to 1.22 times, meaning that Mr. DIY Group is consistent and can produce 1 ringgit and 22 cents sales for every 1 ringgit of their assets. Meanwhile, 99 Speedmart operates with a much higher inventory turnover, which is 6.63 times in 2024, even though there was a slight dip in 2023, which is 6.97 times. This could mean that they are keeping more stocks than before. However, the company's collection efficiency is excellent as they improved from 1.64 to only 0.55 days, which means they convert their sales to cash almost instantly. Despite all that, its total asset turnover fell from 3.46 to 2.80 times, which indicates that while it remains more efficient than Mr. DIY, its sales growth is currently trailing behind. For debt management, Mr. DIY Group maintained a consistent but conservative debt profile throughout the 2 consecutive years, with its debt ratio decreasing slightly from 51% to 49%. Although Mr. DIY Group's time interest and ratio declined from 11.68 to 10.61 times, they remain at a healthy level and will be comfortably cover their interest expenses. Meanwhile, 99 Speedmart underwent a major shift in its capital structure by successfully reducing the company's debt ratio from 80% to 56% in 2034. This largely improved its long-term financial stability. This is further supported by an increase in its time interest earned ratio from 13.2022 to 15.62 times, showing their strong ability to pay their debt. Last but not least, I will be evaluating their profitability trend. For Mr. DIY Group, they experienced a decline in profitability in 2034. The company's net profit margin dropped from 13% to 12%, which suggests that even though their sales are high, the cost of business has risen slightly. This decline carried over to their return on assets, which fell from 16% to 15%, and their return on equity decreased from 32% to 29%. While these numbers are relatively strong in the retail industry, the downward trend indicates that the company is finding it slightly harder to turn their investment and sales into the same level of profit they did in 2023. In contrast of Mr. DIY, 99 Speedmart has shown an improvement in their profitability even as their returns drop.
The company successfully increased their net profit margin from 4.3% to 5%, which shows that they are getting better at managing their daily operating costs. Despite all that, their return on assets declined from 15% to 14%, and their return on equity massively dropped from 74% to 31%. However, this is not a sign of poor performance. This happened because the company's equity and assets grew significantly, making the company more stable and safer.
Today, I would like to explain 4 initiative actions that can help improve the future financial performance of Mr. DIY and 99 Speedmart. First, both companies should improve their digital platforms and online shopping services. Many customers now prefer shopping online, so better websites, mobile apps, and delivery services can help increase sales. For example, Mr. DIY can offer online promotion, while 99 Speedmart can provide online grocery delivery. Second, both companies should improve inventory and supply chain management. This can help reduce storage costs and ensure products are always available. For example, Mr. DIY can use smart system to monitor popular products, while 99 Speedmart can improve its warehouse and delivery system. Third, both companies can expand their business by opening more stores in residential and high-demand areas. This can help attract more customers and increase market share. For instance, Mr. DIY can expand into a smaller town, while 99 Speedmart can open more stores near housing area. Lastly, both companies should use more technology and innovation, such as self-checkout counters and automated payment system. This can improve efficiency, reduce costs, and provide better customer service. In conclusion, this initiative can help Mr. DIY and 99 Speedmart improve their financial performance and achieve long-term business growth. Thank you.
Now, let's compare the leverage debt ratio between Mr. DIY Group and 99 Speedmart. Looking at the debt ratio, Mr. DIY has 49%, while 99 Speedmart has 56%. This means Mr. DIY carries less debt compared to its asset, giving it a safer financial position. In other words, Mr. DIY is less risky because it relies less on borrowing. However, when we look at the time interest earned ratio, Mr. DIY record 10.61 times, while 99 Speedmart show a stronger figure of 50.62 times. This tells us that 99 Speedmart earn enough profit to cover its interest payment more comfortably. So, even though 99 Speedmart has slightly higher debt, it is in a better position to pay off its interest without financial stress. In summary, Mr. DIY is safer in terms of debt levels, but 99 Speedmart shows stronger ability to handle its interest obligation. Next, let's look at the efficiency ratio, which measures how well each company uses its resources. First, the inventory turnover. Mr. DIY records 2.33 times, while 99 Speedmart achieves 6.63 times. This means 99 Speedmart restock inventory much more frequently, showing faster sales and better inventory management compared to Mr. DIY. Second, the average collection period. Mr. DIY takes about 1.5 days to collect payment, while 99 Speedmart collects in just 0.55 days. This is because Speedmart operates mostly on a cash basis, so it receives money almost immediately, which can improve cash flow. The last one is total asset turnover. Mr. DIY has 1.22 times, while 99 Speedmart records 2.80 times. This shows that 99 Speedmart uses its asset more efficiently to generate sales, meaning it gets more revenue out of every ringgit invested in asset. Overall, this efficiency ratio highlights that 99 Speed Mart is quicker in managing inventory, faster in collecting cash, and more effective in using its asset compared to Mr. DIY. That's all from me. Thank you.
Now we move to strength and opportunities for company Mr. DIY and 99 Speed Mart. For Mr. DIY, one of its main strengths it is wide variety of household and lifestyle products offered at affordable price. This allows customers to purchase many items in one place, making shopping more convenient. Besides that, Mr. DIY also practice a strong cost leadership strategy supported by efficient procurement and large-scale operation, which help the company maintain competitive pricing and strong market presence both locally and internationally. In terms of opportunity, Mr. DIY has the potential to continue expanding into more international market through partnership and new store format. In addition, the growing demand for affordable products, especially during economic uncertainty, give the company an opportunity to strengthen its value for money positioning and increasing sales growth in the future. For 99 Speed Mart, one of the strengths is the strategic location in residential areas. This makes the store highly accessible and convenient for customers to buy daily necessities. Furthermore, the company has an efficient distribution and logistics system that help reduce operating costs and ensure consistent product availability, allowing it to offer competitive price and build strong customer loyalty. In terms of opportunities, in 99 Speedmart can further expand into international market and increase the number of outlets across different areas. The increasing demand for affordable daily necessities and support from government initiatives also provide opportunities for the company to strengthen its market and sustain long-term growth in the retail industry.